This week, we're speaking with Rob Carrick, who is one of the most respected journalists in Canadian personal finance. He's recently retired, and we wanted to spend some time looking back on what he's experienced and what has changed over the years, but also looking forward to think about what might be on the horizon. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. Our guest this week is Rob Carrick. Many of you will know him. He's spent almost 40 years as a journalist and almost 30 years as the personal finance columnist for the Globe and Mail. He's recently retired and has a treasure trove of stories that he can share with us. Rob, how are you today?
Very well, John. How are you doing?
I'm great. It's always a pleasure to speak with you because we've known each other for a long time. I've been a long time fan, and I think it would be just wonderful if we could take some time to reflect upon your, I don't think it's a stretch to say illustrious career, certainly very influential career in Canadian personal finance. So I was originally going to ask you some of the questions about your final article that you wrote as a send-off about the things that you've experienced over the years. I can't find the article, but I think there are a lot of things that are worth discussing that are topical even in 2025. And maybe I'd like to see if we can maybe begin by having you look back and maybe offer your thoughts on the 2 or 3 things that have changed the most since you've started writing a national column in the national newspaper?
You know, one of the things, and I think it's very apropos to what you do, is the arc of change in the financial advice profession. You know, when I started, and it would have been, in the late 90s, and I was suddenly this new person writing about personal finance in the Globe and Mail, and my email address was there, and I started to get a lot of people writing me. And what do you think the number one topic was, if I remember correctly? It was, I'm unhappy with my advisor. My advisor's selling me these high-priced mutual funds. I get no advice. I feel like I've got portfolios that aren't what I want. I can't ever get my advisor's attention. And that really threw me. I thought, wow, the advice profession must be really bad because all their customers are getting in touch with me and none of them are happy. And I started, writing a lot of columns about advice. What do you get? What's the cost? The idea of fiduciary duty, which has been sort of tossed around for a long, long time. It's never really gotten traction, but it has been out there. And so I formed this pretty negative view of the advice business. And then I got out to more events and I met more advisors, or we spoke and interviewed more people, and I realized, okay, no, there is a professional core of advisors out there who are doing good work. And I had to sort of reconcile the two. And I found that as time went by, there was a rising tide of professionalization in the advice business. And I'm not going to tell you, and I don't need to tell you, that there are still problems out there. There are still huge conflicts of interest. There are still clients and inappropriate portfolios, but the median quality has improved quite a lot. There's much more of a financial planning overlay on advice now. It's not all about hustling mutual funds and collecting the trailers and the front end loads or the back end loads. It's much more advice focused. I mean, it has further to go, but the improvement has been significant. So that would be one of the biggest changes I've noticed.
Yeah, and it's wonderful. And I agree. And it's funny because that is something that I, in the early days, harped on perhaps more than anything else. My first book, The Professional Financial Advisor, was talking about how the business of giving advice needed to professionalize by moving away from commissions and toward fees, and by being more transparent and more evidence-based and so forth. And it's great to see that we've come so far. If it were up to you, what would you say would be the 2 or 3 changes that are still needed to get the ball over the goal line to make things better still, accepting that progress has been made?
I'd love to see a fiduciary duty required. I mean, I think, when I was writing about it, I got so many people saying, what do you mean there isn't a fiduciary duty? What are you talking about? Like, how can people advise me about my money and not have a duty to put my interest first? They're mystified. I think people expect it. And sort of, if you said, do you think there is one already? If you went and did a survey of investors with advice, I think quite a number of them would say, of course there is. They would expect there to be. And I still recall an industry event I was at many, many years ago. And there was a panel discussion on the fiduciary duty, which was being discussed at the time. It was before it got squashed. And there was a lawyer representing one of the big banks up there. And the way she trashed fiduciary duty as unnecessary and a silly encumbrance on advisors, I thought, well, we're never going to quit this one. And there were a few advisors in the audience who were just going, oh, wait, can you believe this? Like, we think the exact opposite, but the prevailing view is that this is never going to happen. I'd love to see it, though. I think that would be a huge win for people, and the transparency and the confidence it would give people. One other change I'd like to see is more fee-only planning, accessible, scaled planning for people at all income levels. I tell this to financial planners all the time. You have no idea how many more customers are out there than beyond what you have already. And I know some are like too busy. In fact, they've got lineups and everything, but my email in basket was just stuffed day by day with questions from people. And a lot of the questions were, these are financial planner questions, not personal finance columnist questions. I cannot perform a full body scan of your finances and tell you what I think. I just think there's a mismatch. The planners are out there. They've got their business models. They've got their preferred clients. There's a lot of people there in all income brackets with a lot of questions, and planners are the ones to answer those questions. And I think offering a fee-for-service option would be a way to connect you with those, and perhaps investment management comes next once people understand what they need to do.
So I would add a couple of things to what you just said to hopefully add some context and maybe offer a little bit of optimism as well. People who are certified financial planners are basically right up to the line of being fiduciaries with regard to their planning obligations. It's not technically right there, but it's about as close as you can get to being a fiduciary. So when it comes to the planning work that's being done, if you're a CFP, you're for all intents and purposes being held to a fiduciary standard, although it's not called that. But the other thing that I wanted to point out to you is that I was very frustrated during the global financial crisis of 07 to 09. I had investment policy statements I was working on a fee basis with my clients, and the investment policy statement says this is what the asset mix is going to be, and it's in writing, and they've signed off, and we've all agreed. And then stock markets started to tumble, and I would start calling my clients, and I would say, well, we agreed to whatever, a 60-40 portfolio. It's now 50-50. We've got to take 10% out of bonds and put it into stocks and rebalance and buy the dip and go back to the target allocation. Even though we had discussed it, agreed to it in writing, my clients almost all said, nope, not going to do it. I couldn't get them to do it. And so what frustrated me is that here I was giving what I felt was correct advice, consistent with good financial planning principles and personal finance principles. I got my clients to agree. I even got my client's signature on an investment policy statement saying they agreed, and I still couldn't get them to do it. And as a result of that, I made the decision that I was going to do what I could to become a fiduciary. And so I started speaking to people at the OSC and at my firm. And I said, so if the regulators cannot impose it upon me, can I impose it upon myself? Can I take a so-called fiduciary pledge whereby I promise to act in my client's best interest? Will you let me do that? Says John to his CEO of the firm he's at and to regulators. And the CEO and the regulators say, nope, can't do that. We don't know that we can actually bind you to that. So it was then that I realized that if you're a portfolio manager in Canada, and there's over 100,000 people who have a license to sell financial products, but there are maybe 3,000 portfolio managers in Canada, portfolio managers act with discretion. And as a result of having discretion, they are fiduciaries. And that solved two problems. So I made the decision in 2009 to become a portfolio manager. Number one, it solved the problem of actually holding myself to a fiduciary standard. I could opt in. I couldn't have regulators impose it on the industry, but there are a few people who could put up their hand and say, no, I want to be bound by this standard. I'm okay with it. So I was one of those. And there's still only a few thousand in all of Canada. But the second problem that it solved was I didn't have to worry about getting my client's consent to rebalance the portfolio because I'm acting with discretion. So now if it's buy low, sell high and a 60-40 portfolio becomes 50-50, I can just sell 10% of what's not down and use that 10% to buy what is down and bring it back in line. So there, again, it's not a perfect solution. It's not an elegant solution. It's not a comprehensive solution, but it's a solution that's been, on my radar that I've been using now for 16 years. And so it's not like it hasn't been out there. It is. So that's good.
That's good to hear. I'm thinking though, what we need is a top to bottom fiduciary
Yeah.
standard. And, I love the idea that CFPs are like 95% of the way, but I mean, I'd like to see them go the other distance and then have a little logo saying we're fiduciary standard or something like that they put underneath the CFP. To clients could say, what does this fiduciary standard mean? That you could say, it means I work for you and your needs come first. Also, fiduciary standard needs to be brought into the sales side of things as much as the planning side, because that's really where it matters. Which equity fund do I pick? The one with the higher trailer and that sort of thing. It's learn not to demand, tidal waves of change in the investment industry, because they're never going to happen. The ripples of change, and you just described one, so that is a plus.
Right. So I want to talk to you about another one, which is one that you and I have shared from the very get-go, which is product cost. To what extent do you believe the average advisor understands the evidence regarding product cost correlating to performance?
I think the level of understanding has improved quite a lot. And as evidence, cite the rise of ETFs as assets. The ETFs aren't driven entirely by do-it-yourself investors, although some people have that idea. Like the asset levels there's huge muscle in these flows, and it's being driven as much by advisors and institutional investors as retail. So I think, I'll design you a portfolio. Here's my advice fee. And the product fee is going to be like 20 basis points because I'm using like index tracking ETFs. Now, the ETF industry is following the playbook of the mutual fund industry, and then they're throwing money at every single asset class, legit or not. And the product prices are rising and rising and rising. And like all the new ETFs, I'm looking at like how often till we see a bunch of ETFs above 100 basis points with their all-in management expense ratio. So there is that tug towards higher costs, even in the low cost world. But I think that the asset flows are still very strong into the low cost index ETFs. And that to me says advisors want low cost products, and they must do that out of belief that that's best for their clients. A, they probably can't outperform the index. And B, low cost work. Why can't they outperform the index? Because the MER for the S&P 500 fund is like 8 basis points or 6 basis points, and which is to say free. I'm buying the index for basically free. And advisors are thinking, yeah, I think that's not a bad proposition. And that leaves me, I'll buy these ETFs, design the portfolio, and that leaves me lots of time for planning and hand-holding and coaching and chatting and all that stuff that really builds relationships.
So again, I will piggyback on what you're saying, because there are a couple of things, one looking back and one looking forward, that I think would put that into context. So again, we agree. What I would say is the main driver behind the move toward low-cost products is the move toward industry unbundling. Most people, first off, ETFs didn't even exist 25 years ago. So when I started in the business, there was no such thing as an exchange-traded fund that was available really in Canada as an option, and neither was there an index fund option. And so now there are a number of the low-cost options are also the options that do not pay a trailing commission. And it was only with the advent of being able to charge a fee separate and distinct from the product cost, instead of getting paid by the product supplier as a commission and or trailing commission, you could use a product that pays you nothing, cost the client less, and then charge a fee. So part of why ETFs have taken off is because the legitimacy of an asset-based fee business model has been accepted, which was not accepted when I started trying to move toward charging an asset-based fee back in the day. My firm wasn't even set up for it. They couldn't accommodate me. I wanted to do it. Again, it's one of those things where there are agitators, people that are pushing for change, such as yourself and such as myself, who are trying to do it. And the industry is actively getting in their way and saying, well, we don't want to do it, so we're not even going to give you the option. Because if we give you the option, you might take it. We don't want that, So we're not going to do that. So that's looking back. That's, I think, a lot of what changed from maybe 15 or 20 years ago to today. Looking forward, what I think is also going to be changing things is that we're now moving toward total cost accounting and reporting. And so starting in January, in 4.5 months, firms are going to be keeping track of how much products cost. For the past 3 or 4 years, there have already been disclosures as to how much you're paying your advisor as an asset-based fee, but there are no disclosures yet as to how much the products cost. So they're going to start keeping score in January of 2026, and they're going to report on this starting in January of 2027. And so we're about a year and a half, a little less than a year and a half away from people actually getting an opportunity to compare apples and oranges. What are you getting and what are you paying in total if you're using a mutual fund that has a trailer embedded in it? And what are you paying if you're using an advisor that charges you a fee and then uses other products such as individual stocks and bonds and ETFs and products that don't pay any kind of an embedded commission? So that will also go a long way toward enhancing understanding and hopefully improving behavior. So once again, I think the theme for this discussion is that progress is being made. It's just remarkable how long it's taken. I was wondering if you can maybe take a bit of a stroll down memory lane, right when you started started writing for the Globe and Mail, and not long after I started in the business. In 1995, there was a lovely lady by the name of Gloria Ann Stromberg who wrote an initial report on the mutual fund industry. And she said that it was very clear that the business structure of commissions and trailing commissions were skewing the advice that was being given, and that it needed to change. And it has taken basically 30 years to change. Do you have any thoughts about maybe what were you expecting when Gloria Ann's report came out? And looking back, how do you think it played out, and what were your surprises?
Well, I remember Gloria Ann Stromberg very well. In fact, late in her career, I remember going out for coffee with her. We were just sort of looking back and talking about, all her efforts to change things and how resistant the industry was. And she was totally realistic about that. She didn't feel she was a martyr or anything like that. She was doing what she could, but understood what she was up against. But, the preceding comments you made and that I made, and you link it up to Gloria Ann Stromberg, it makes me think that part of the progress we're seeing in professionalizing advice is the de-mutual fundization of the investing world. The mutual fund industry had too much power, and the power was used for the benefit of their asset bases, and it wasn't used for the benefit of investors. And we're peeling that back bit by bit. So the unbundling you talked about, that's exactly what de-mutual fundization is. And the advisors I mentioned who are using ETFs, they could be using F-class mutual funds, but they're not. They're using ETFs because they're much cheaper and the performance is quite good because of those low fees. And I think Gloria Ann Stromberg started that process. She made people aware of the conflicts, of the embedded fees, of the way the mutual fund industry was like their world, and we all just lived in it.
Right.
Remember, like personal finance columnists like me, we worked so hard to kill the deferred sales charge. And then the front end sales charge went to zero. So it was like all these gradual bits of progress. Then the unbundling and the fee-based accounts started to rise. And it was very good for advisors too, to have a locked in fee. And it was transparent and everything else. But I just feel like mutual funds have their role, and they are quite useful for certain types of investors, and they are easy and very, very suited towards the beginner. But they had too much power. And so I think, they still have a tremendous amount of assets. Some of it's well-earned and some of it's not well-earned. And I think that we need to sort of crack open more of that and have more investors thinking about what they're doing. And I think that total cost accounting will help. I'm not wildly optimistic about how much it's going to help, but any disclosure is good disclosure. So.
Okay, so that was a lovely walk down memory lane. Now I'd like to see if we can dust off the crystal ball and look forward. Because of your unique position, you get to see trends as they're evolving, and you're maybe a little bit ahead of what people are thinking, because you're not only speaking to advisors and people in the industry, but you're also, up until a month or so ago, getting copious correspondence from ordinary investors who have questions. What would you say are likely to be the biggest trends in the next few years, or as far as you can see? And specifically, what are your thoughts with regard to robo-advice and the role of artificial intelligence?
I'm waiting with keen interest to see someone in the investment industry bring AI to bear to provide financial planning and rudimentary investment advice for the less affluent segment of the investing market, which is pathetically underserved. I mean, these are people going into bank branches and buying a bunch of junky mutual funds or index-linked GICs or whatever. I have for the past 10 years heard of various entrepreneurial types, advisors with an interest in the profession, try to develop some sort of model for providing financial planning services for, the masses, the less affluent masses, and they have not clicked. but I'm optimistic that this can be cracked. It has to be done by someone with some credibility. It has to be transparent. It has to be reasonably simple. But there is a desperate need for planning by people, for people at all levels. In fact, it's almost more acute when you don't have a lot of money because the mistakes become more serious. I mean, you can really hurt yourself. Whereas you have a lot of money, okay, you paid more tax, big deal. I'm waiting to see how AI does on that. Robo-advisors are interesting. I'm a bit disappointed that they haven't really done more than they have. There's all this attention given to them, and I know Wealthsimple has significant robo-advisory assets, and the last I spoke to them, they were very serious about that line of business, but it has zero buzz, as far as I can tell. I think it's quite suitable for a lot of people, but John, we're in a bull market as we speak, and everybody thinks, I can do this. I got it, and I'm actually pretty smart at this, and I know the next big market downturn is going to flush a lot of that confidence out, and maybe robo-advisors will benefit from that. But anyway, I don't have a huge amount of optimism that they're really going to flourish in this country. There's a market for them, but they don't seem to be able to get much traction there. I think the biggest opportunities going forward are for planners who offer their services for a flat fee. Because you can invest however you want. You can be a DIY person. You can have an investment advisor who doesn't do much planning. You could have a planner who is licensed to sell investments and provide advice. Getting questions answered, that's the future of financial planning. And I mean, that's really what it is. It's not just helping rich people minimize tax and make sure their children can buy 5 houses. It's about helping people who don't have a lot of retirement assets max out, get the best possible, helping people decide, can I afford a house or should I just forget it? Can I afford to have the number of kids I want to have? Can I afford to travel? Can I afford to have a sabbatical year? All kinds of questions like that through the whole life cycle. And it's not just retirement. I think there's a massive amount of potential there. And I think AI could probably help there. But I'm not really seeing a ton of AI being deployed in the retail investing space just yet.
It's funny because I think there might be, a way to dovetail the questions, your concerns about planning and my question about AI. A lot of what's being done with robo-advisors is using algorithms to apply it to portfolio construction. If AI does in fact accelerate and mature the way the people who are using it say it can and will, I don't think it's a stretch to think that in a few years we might have robo-planners using AI. And then the question then becomes, how do you monetize that? Because if you could just build a website or make it free, I think one of the problems that we've all lamented in the industry is that those people who oftentimes have very little by way of financial resources, they oftentimes need advice the most, but they don't get it because there's no way for the people who would be offering the advice to get paid sufficiently to make it worth their while. And so the gap persists. I'm wondering maybe if we could talk a little bit about what that means for financial literacy and financial education. In your opinion, what can be done to help the average person? And I'm thinking specifically the average person who maybe came to Canada from a foreign country and is still struggling just to learn the language, or the average person who only has a high school degree. There are lots of people in Canada you write mostly for, and I service, upper middle class people. Most of the people that read the Globe and Mail would have been people that are upper middle class people. And there's a whole swath of humanity that is being overlooked, not deliberately, but they're not being reached. How can we reach ordinary people to help them make better wealth decisions as we go forward?
Workplace financial literacy program strikes me as the best idea. When you throw financial literacy into the wind and you say, I hope some lands on people, it does, but the progress is glacially slow. Like the wide distribution model, it's worth doing, but it's not, don't expect great results. And so you can have financial literacy month every year from now until the end of time. And it's really going to make the industry feel good that they're helping, but it's not really going to make big change. I'm a big believer that you have to provide financial literacy at the point when it's needed. And, I'm all for teaching it in high schools, but there's a lot of people who think that's going to fix everything. I learned a lot of stuff in high school that I didn't retain the day I left high school, it was including copious amounts of math. I think you're going to need to apply it when it's needed. And that's when you're in the workforce. As soon as you're in the workforce, you're managing money. You got to be thinking about all kinds of different things. If I had a substantial workforce, I would be instituting this. I would be talking about, here is our retirement savings program. Here's our match. Here's how crazy it is not to grab up every cent of it if you can, because it's free money. It's basically your salary that we're diverting into your retirement. Do you want us to pay it to you or not? And when you say, no, I'm not going to participate in the pension, you're saying, no, I think I'll just decline part of my salary. You know what? More and more companies are concerned about the debt levels of their employees and what that's doing to productivity. They're providing debt services. I'm hearing about, instead of just group RSPs, there's group TFSAs and group HSAs and group RESPs. There's debt relief being provided. You know what? HR is becoming much more nuanced. And that, to me, is a sign that there's a room for financial literacy programs to help guide people through all these various programs and how to get the best financial results. You know what? I think that's where you have their attention. I have heard that companies themselves have trouble getting employees to navigate this stuff. But that, to me, doesn't say the employees aren't interested. It says you have to do a better job of engaging them on this. Somehow get their attention, get someone in, get a program, use AI. I mean, you know, all the big HR consulting firms have to be thinking about AI models for helping employees, you know. Anyway, that'd be my suggestion in the workplace.
So that's, I would say again, hopefully I would call that optimistic. I like to think that the future will be brighter. The pace of change is slow, but the arc of change is toward things being better. And I'm gratified to hear what you're thinking. And I tend to think that I share your viewpoint. It's lovely. So the podcast is called Make Better Wealth Decisions. We're coming to an end. Rob, what advice would you give? I'm going to ask you open-endedly. If you want to help people make better wealth decisions, what one bit of advice would you give above all else?
The thing that concerns me most in my late phase as personal finance columnist was spending levels. You know what? I hate to be the guy who says, spend less, sacrifice more. You have to scrimp and save, because I think people should be able to enjoy their lives. And if you can't enjoy your lives, what's personal finance about? You know what? It's just not going to work. But I see people spending on things and I know they can't afford it. And I'm thinking, like, society has just tuned up our brains to max out on spending. I look at what people spend on cars and stuff and I'm just blown away. And I think, could we ratchet it back one click? And I think that would give us a little bit more flexibility, would get us through the harder times. It would give us more to invest. It would give us more flexibility to do things like take off a sabbatical year or take a nice trip or put some money in our TFSAs and that sort of thing. So I think the country needs to figure out a way to just dial it down one small amount.
Okay, well, that's worthwhile advice and something that I also share and echo. So Rob, I want to thank you again for not only for joining me today, but for your massive contribution to personal finance over the years. You've been a great source of inspiration and a great source of knowledge for me personally, and I know for many, many other people that are listening today. So thank you, and I want to wish you all the best of success in your retirement.
Thanks, John. And back at you. You've been doing your work for almost as long as I have, and we have had many conversations over the years, and the reason is because I respect what you do, and you are a respected voice in the profession. So always glad to chat with you.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.